And welcome to On the Spot. My name is Kevin Hill here with JP Hampstead, and we are in the middle of earnings season for trucking and logistics, and a couple marquee names have come out in the last few days, C.H. Robinson being one and ArcBest being the other.
Oh yeah. I just wanted to mention those really quick. I thought that they're really interesting. Just looking over the earnings call transcript at C.H. Robinson, a couple of really interesting questions. Tom Wadowitz from UBS led with some fire right out the gate when he said, hey, you're talking about all of your progress in technology. It's not showing up in net revenue. When's that going to happen? That was interesting. But one observation that Todd Fowler at KeyBank made that I thought was significant was that he said it was the first time in 9 quarters that Robinson's rates charged to shippers grew faster than the rates paid to carriers, right? They actually had sequential margin expansion, right?
Yeah, you've seen that, and we've talked about it quite a bit over the last couple of years, is the margin contraction that keeps happening with C.H. Robinson, but it looks like the market's turned. It's a good market for most everybody, and we're seeing that at C.H. Robinson.
Yeah, and to give Bob Biesterfeld and team credit, I'm not sure that in the current super inflationary rate environment that gross profit percentage or gross margin percentage or whatever is really the best metric to capture how well the company's doing, right? So right now NAS is at 12.1%. Normally you would think that's low. You would think, they're hurting, they're not making money, but of course that's not true. And gross profit per truckload shipment is up more than 100% year over year, right? So it's really about net revenue dollars per load, which everyone who runs a brokerage knows.
And this is the last quarter that we're going to see with really easy comps. Going into the fourth quarter, you're going to have tougher comps, and then of course going into 2022, you're going to have very tough comps coming through. So you're seeing gangbuster earnings and gross revenue, and margin per truck and revenue per truck. Every metric that has a price tag to it.
I would argue that there are tough comps now. Maybe not for the brokerage, but on the asset side, they're getting into tough comps territory where you already had rates go up a lot by Q3 of 2020. That was hurting the brokerages because they hadn't had time to reprice contract rates yet. Now they have, and they're getting a little bit of that tailwind.
What about ArcBest?
Yeah, the only thing I wanted to mention about ArcBest, which I thought was super interesting, is that on the asset side, the LTL fleet, the OR operating ratio was down to 86.7%, which is good for an LTL carrier. It's great for Fort Smith. The other interesting thing, following the acquisition of MOLO Solutions, Modern Logistics Solutions, freight brokerage out of Chicago, run by Andrew Silver and Matt Vogerich, not asset light revenue is 44% now of ArcBest total revenue, almost half the company. It probably will be more than half the company soon. I thought that was fascinating. Fascinating statistic. It's really puts a lot of context on how management will deal with union renegotiations here in a little bit and all that kind of thing.
That's always a tough negotiation, right? Yeah. The unions. There's another article that we saw in Wall Street Journal. It got us thinking about the spot pricing.
Oh,
and
that's
Zillow.
That's right.
Zillow is pulling the plug on, I think it's Zillow Buy, wherever they're
buying.
iBuyer. Yeah, so the iBuyer, wherever they're kind of the algorithms are bidding on houses and flipping those houses, getting into kind of. It's a little similar to the brokerage in a way where you have algos trying to predict future spot prices in housing.
Yeah, so everyone knows Zillow as a marketplace for houses. They estimate the values of the houses, they sell houses, they have all this data. Well, they figured, hey, why don't we try to make money off this? Why don't we just buy houses that we think are going to go up in value and then sell them 6 months later or whatever for a profit? How hard could it be? Housing prices only go up. Right. Well, it didn't really work that way. there was some reporting a few weeks ago that they were underwater on like 2/3 of the houses that they owned. And then and then yesterday, Wall Street Journal reported that they're pulling the plug. It was really interesting. If you look in some of the real estate media, you can see the details. They were like they're underwater in 90% of the houses they owned in Phoenix, like 80% in Dallas.
Yeah, and it wasn't necessarily the housing prices went down; they just didn't appreciate as quickly as the appreciation kind of trailed off that growth
They
level.
overpaid because they were too aggressive, and it's so interesting to me because it's like a really visible failure of a pricing forecasting engine, right? That basically had unlimited resources behind it. I mean, Zillow raised billions of dollars in VC, but even after it went public, it was still issuing more equity and raising billions of dollars.
It was raising billions of dollars, and that business segment that was buying houses was projected to be their cash cow. It was their new superstar that would turn into a cash cow. And they were betting a lot of chips on it, and now they're closing it down.
Yeah, and to me, it's almost like, if Zillow can't forecast housing prices, maybe like the best that we can do right now is get sort of like you want the freshest, most granular transaction data available. That may be as good as it gets. You're not going to be able to predict the movement of markets, whether we're talking about stocks, houses, truckload rates, 6-9 months in advance. Like there's so many exogenous factors. You can't account for what Congress will do. You can't account for what China will do. You can't account for what sea surface temperatures in the Gulf of Mexico will do. And the best you can do is just get data as fast as you can.
Yeah, there's a lot of shocks to the system right now in truckload, and trying to build an algo or some kind of predictive rate tool right now that will go 6-9 months in the future is
it's tough.
Difficult.
It's
really
tougher
is,
than it looks, and if you commit to contract rates using that kind of calculation, you're eventually going to blow yourself up.
Yeah, you definitely are. Well, thanks for joining us for On the Spot this week. We'll be back next Wednesday.